Jeffrey Cleveland, the 10-year Treasury bond is at 1.9%. Most economists thought it would be much higher by now. So does that signify weakness in the economy?
Greg, I think the way we look at it at Payden Rygel is that long-term interest rates are driven primarily by two big factors. That's inflation and then the path of short-term rates out over time. And if you think about both of those components, inflation is very low. It's been below the Fed's 2% target for 6 years now. We're at 1.2, 1.3% on the core measure of inflation that the Fed follows. So very low levels of inflation point toward low longer-term yields. And then short-term rates. If short-term rates are near zero, and maybe at the end of the year they're higher, and maybe at the end of 2016 we approach, say 2% on the Fed funds rate on overnight rates, that's still very, very low. And that implies also that longer-term interest rates can remain low. So I don't think it's really a sign that the bond market is smart or the bond market is smarter than the equity market. It's telling us something about the U.S. economy. We think the U.S. economy is fine, but if you look at inflation and short-term rates, that's how you get to low interest rates in the longer part of the curve.
If the U.S. economy is fine, how do you put that weaker than expected March jobs number into context, especially when you put it against some of the tepid economic data we've been seeing and worries about Q1 GDP?
Yeah, we actually like the non-farm payroll data versus looking at some of the GDP data. Some of the GDP data or the retail sales data, it's really volatile. In Q1, I think you should ignore most of that and look at non-farm payroll growth. Now you could say to me, well, yeah, but in that last month in March, we only got 126,000 jobs, so non-farm was weak. You have to look at it in the broader context. Over the last year, Greg, 3.1 million jobs. We had 12 or 13 months in a row of 200,000 or more jobs in the non-farm payroll report. That's great. You have to go back to 93, 94, or even all the way back to 84 to find a stretch, to find a year where we had better jobs report than we've seen. So that's how I think the context you want to put it in. On a year-on-year basis, payrolls are still growing 2.3, 2.4%, and that's great. So I still think it tells us that the economy is fine, that we're doing well.
Are you as excited or more excited about Europe right now? Because a lot of analysts are coming in here and they're telling me we like Europe, especially in terms of their economy and their stock market, better than the U.S. right now.
Well, I think the U.S. economy is on better footing. The U.S. consumer is better. Household balance sheets are better. So if we were doing a one-to-one comparison, sort of like a March Madness type thing, I would take the U.S. economy over Europe. However, I think the European economy has turned. So what I was hearing from a lot of people is that the only thing that was going to save Europe was Draghi and a U.S.-style quantitative easing program. And that was it. That was the thing standing between Europe and the economic abyss. And I think that's wrong. I think signs that the economy is getting a little bit better, if you look at PMIs, if you look at broad measures of money and credit, those look like they're thawing. So I think maybe we're at the early stages of things getting better in Europe. But we're still really far behind the U.S. I mean, you're talking about, Greg, an 11% unemployment rate versus a 5.5% unemployment rate in the U.S. So it's like night and day comparing those two economies.
And then finally, as an investor, how do you put all this into context?
Absolutely. So we don't worry that interest rates have to be dramatically higher, but we do think a lot of investors in the last 3 or 6 months have been very captivated by sort of deflation and that interest rates are going to stay low and go lower. And we think that might be a little bit overdone, Greg. So we might see longer-term interest rates push a little bit higher here towards the end of the year and into next year. So that's the first big thing. We still like bonds in that environment. We still think you can find attractive opportunities in high-yield, investment-grade corporates and some places around the emerging world as well. So we're not afraid of bonds. We don't think you should sell all your bonds and get out because Armageddon is coming to the bond market. So that'd be the first thing. The comparison between the U.S. and Europe, what wins out over the next couple of years is the dollar. We think the dollar continues to strengthen. If you look at the U.S. dollar, it tends to move in these long cycles that play out over 70 or 80 months. And we think maybe we're halfway into that, Greg. And so the U.S. dollar versus the euro and some of its other peers will continue to appreciate. That also means, though, investors should be a little bit cautious on commodities. I think if the dollar is going to strengthen, interest rates in the U.S. are going to be a little bit higher. I think oil remains under pressure and perhaps other commodities that don't do as well in a rising rate type of environment.
All right. Thanks a lot, Jeffrey.
Absolutely. My pleasure.
Good stuff. Thank you for watching The Street.